Hello and welcome to Supergrowth Multibaggers Daily Report, April 8th. We'll take a look at a couple of stocks and at the market in general before it opens. First, we'll take a look at the overall market. Our rating, risk rating, currently inordinate, new purchases 2% of cash position. That's because the market 3.3%. The sell at price is 3.3% above the current market, and the buy at 6.8, so roughly twice as close to the sell as to the buy. And we also included in our rating are all of the, or the 50 fastest growing, low debt, highly profitable companies traded on U.S. exchanges. We track those daily. In fact, we track them throughout the market day. And again, the proximity of those to their sell-at price is much closer than their buy-at price, indicating that it's risky to make new purchases now. Take a look here at the SPY chart. Taking a moment to get up. All right, so this shows the algo-generated purchases. This is basically a buy on weakness, sell on strength pattern recognition software that works off of the simple moving average. So it detects patterns in terms of stocks. When they fall significantly below the moving average, it buys, and when it reaches an inordinate level above the moving average, it sells. You can see here it began buying at the end of February last year, and the market continued to decline sharply, of course, and it continued to buy. So it's not, trying to pick bottoms. It's trying to pick prices at which the odds are in the investor's favor, over a 1 to 2 month holding period. Of course, a number of our subscribers totally ignore our sell signals and just buy, and that works great as long as the market keeps going up. You see in here, it bought and then very quickly sold. In fact, it bought twice and then sold. And that's the advantage of selling, positions, is it generates cash. If you can get out at a quick profit, it will then have the cash to take advantage of any further decline that may materialize. So, over the last 12 months, it's generated, I don't know how many trends. Just glancing at it here, it looks like it's purchased about, 15 times over the last 12 months. And average holding period 8 days, average profit per transaction 7%, which, translates to a 300% return annualized. The stock we'll take a look at, Supergrowth Multibagger, number one right now, the most profitable, fastest growing, low debt company traded on any exchange in the United States, perhaps even in the world. And you see here that, just how dramatically the company's cash flow has grown over the last 12 months. Revenue's gone up 300%. Free cash flow has gone up 900%. So three-year average annual free cash flow growth is 800%. So phenomenal performance, due to emerging trends in work at home, etc., that everybody's aware of. Financial strength trends support, when you see very dramatic improvement in free cash flow and a declining or flat financial strength, this middle graph, there's something generally not right. There's either company reporting earnings that don't actually exist, or more frequently, huge capital expenditure or R&D requirements required to support future free cash flow growth, and it's generally a good warning sign, reliable warning sign. Okay, so here's a quick look at the Zoom graph. As these COVID stocks have lost some of their enthusiasm. I mean, it's not a question of financial performance deteriorating. In the case of Zoom, its rate of growth is deteriorating. Maybe we'll take a quick look at that in just a moment, but it's decelerating in the sense that it's not growing as fast as it was a year ago, but the growth is still extraordinary. The rate of growth isn't 900% anymore, but it's several 100%. So anyway, stock decline has been declining, I guess, from a level of around 600 down to its current 325. So has buy at 281 according to our pattern recognition software, and sell at of around 370. So a good stock to watch. If it continues to decline, we'll definitely take another position in it. The algo has identified 1, 2, 3 purchase points over the last 12 months, and 3 sell points. Average holding period of 14 days. Profit per transaction around 20%, for an annualized return of just under 500%. BJ's Wholesale Club, another company that arguably is benefiting primarily from COVID, although this company's memberships have gone up, and it's doing, taking a number of steps to ensure that, or try and protect the business that it's built over the last year. See, the stock really hasn't done much for, that's about 6 months or so. And we currently have, or the price algo determined a buy-at price around $40.86 versus the current $45.56. It's the company closest to our indicated buy-at price of any super growth multi-bagger. Very well-run company, paying off debt. It was the subject of a leveraged buyout several years ago, and then went public a couple of years ago. This is the summary report on it's probably, although its financial condition is certainly very adequate and dramatically improving, it's probably the weakest financial current strength of any company we've bought in the last year, I think. Well, I guess not Startco probably. But anyway, the company is experiencing substantial improvement in its financial strength, in its cash flow. The growth is exceptional. 1-year cash flow growth of 170%. 3-year free cash flow growth of 200%. So exceptionally well run, well positioned, benefiting from COVID, but regardless of COVID, a company with excellent long-term prospects. I guess that's it for today. We've also just produced, I'll put a link in the written notes to this, and you can also find it on our YouTube channel. There's a link at the bottom here. But we've just recorded a 20-minute brief overview of all of our research, all of our analytical processes, the logic behind it, how we do it, and exactly the significance of many of the different things I've talked briefly about today. Thanks for your interest in the research, and please be in touch with any questions. There's a subscription sign-up page on our website should you be interested in joining us as a subscriber, and thank you again.